Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today, I'm excited to have Cliff David on with us. Cliff, how are you doing today?
I'm well, Michael. How are you?
Doing good. So Cliff is coming to us from Phoenix, Arizona. Cliff is the Executive Managing Director at Institutional Property Advisors, or IPA as we call it. And he's pretty prolific with his partner, Steve. They're pretty prolific apartment brokers in the Phoenix market, or probably greater Arizona. I imagine you cover most of the state. And you guys have really been on a tear here for a long time. So maybe, Cliff, just give a little brief background on yourself, kind of when you get in the business, where do you go to school, kind of we'll take it from there.
Absolutely, Michael. Again, thank you for having me on. From a background perspective, I'm a native of Arizona, grew up in Tucson, Arizona, went to University of Arizona down in Tucson, and after school in 2002, moved up to Phoenix and started selling apartment buildings. So this will be my 19th year with the firm, exclusively in the multifamily sales space throughout Arizona, with a strong concentration in the greater Phoenix market.
And so you guys have really grown quite a bit over the last, 17, 18 years, you said now, I guess 19 years, we're in 2021. Talk a little bit about that. So you came into the business in 2002, probably 2003 was your first year. Maybe kind of talk through a little history lesson of your sales volume. You probably were relatively limited when you first started out, probably peaked out in 06, 07, bottomed out, and then kind of last year, I know you guys had a phenomenal year, but maybe kind of talk through the growth of the sales volume of your team.
Yeah, happy to. So early in my career, I defined it as more private capital brokerage. So my focus was really sub 100 units, very much the bread and butter of the Marcus Millichap platform. And the Phoenix market back then was just a different market in terms of the capital, the investment profile. And so for the first 5 or so years, plus or minus, I focused in that private capital space. Certainly the volume back then is significantly different to what it is today because our business has evolved and changed so dramatically. But you mentioned my partner, Steve Gebbing, and I grew up together, and we united in the first quarter of 2006. So really the first handful of years in my career in that private capital space were really without my partner Steve in the brand that we built as it's known today. So when he and I teamed up, we really just reset everything I had been doing and made it a point to focus in the 100 plus unit segment of the market.
So
and
what did your sales year look like in 2003 approximately, and what was like an average per door sales price on properties back then?
Yeah, back then, it was really $1 to $5 million deals, and your average price per unit was 30, 40, 50,000 a unit was a big number back then.
Yeah.
Obviously, interest rates and cap rates were in a different place. Phoenix has always been very liquid, a transaction-heavy market. So same holds true in 02, 3, 4. But what we saw, like other markets in America, it became very speculative. So the single-family market was white hot. It was a very home ownership-heavy market. It was all about own real estate as soon as you can, buy as much as you can. Therefore, the condo conversion phenomenon really took hold here.
Yep.
Because single family prices were rising, everybody was flooding into home ownership. Investors were buying 2, 3, 4 homes, and so there was a perceived need for an entry level price point, and that's where the condo conversion concept came in. but I say speculative because it never really carried much weight. It really was a kind of a trend, but the amount of buildings that were actually converted.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
At the peak, where were things trading at the peak? And was it 06 or 07 for you guys? Kind of what was you said it's like 40 to 40-ish thousand a unit kind of when you started. Where did it go to? And then kind of where was the trough?
Yeah, for sure. So in terms of the number of sales, and I'll really quote this in the 100 plus unit segment because that's been my the bullseye for me for a number of years now. Back in 2005, there were 219 trades, 100 plus units, represented 4.25 billion in sales volume. The trough, 2008, 3 years later, 19 sales.
Oh, wow.
So keep in mind, that's a 2008 number, but most of that was actually negotiated in 07.
Yeah.
So that 19 is actually a little misleading, which was 19 sales, $476 million. So dramatic to say the least. But it was actually a good thing in a lot of ways because it really led to what we call the maturation of the Phoenix market. And I'll touch on that later in our discussion, but the true fundamentals. What are the economic drivers in Phoenix? Where were we? Where are we now? That decline or that recession was really the starting point of the genesis for the evolution of Phoenix as it's known today.
Yeah, so maybe let's talk about that. So back when you started in the career, the market wasn't very diverse from an economic standpoint. How has that changed over the years, and what does that look like today from a broad diversity of employment and sectors within the greater Phoenix area?
Yeah, it's been significant. So between 2010 and 2019, so that 10-year window, that decade, we created about 530,000 jobs. But what we saw was construction was prevalent. Phoenix will always have a strong construction element, 66% growth in the construction industry in that 10-year window. But when you look at what financial services, information technology did, 43% growth in those two industries.
Oh, wow.
Each in that 10-year window. And then right behind it, education and health services grew by about 42% in that 10-year window. So we saw great diversity and a lot of growth in that more white-collar, career-oriented sectors than we had ever seen before. So that is a big reason why we're the market that we are today.
And so what's changed within the market participants? Is it back when you first started, it sounded like it was a lot of kind of local folks as well as California 1031 buyers. I would assume were fleeing LA, trying to find a little bit lower priced properties within Phoenix, about 4 hours away. What was that like then, and how has that changed for kind of the last couple years of the properties you've been selling to? Who's buying the stuff that you're selling?
You know, it's all over the board, honestly. I'll get into a little bit of detail, but first I'll say in the last 2 to 3 years, as a general statement, about 75% of our buyers already own at least one property here in Phoenix. So you just see a lot of aggregation. Those folks have great empirical data in their own portfolio. They know where asset performance has been, rent growth, et cetera. And so that just gives them more confidence to expand their footprint, therefore making it a little bit more difficult to break into this market as a first-time buyer, to compete with those that have that firsthand data at their fingertips. But we're definitely heavy in the Syndicator capital joint venture, a known sponsor with an institutional JV partner. Phoenix is a big market for that. And then we're really growing our presence, have been growing our presence with the pure institutions as well. And
are you seeing as much California 1031 money today as you did, say a decade or I guess 15 years ago?
Approximately 40% of the Phoenix ownership originates from the state of California.
Yeah,
that's been the historical metric. It really hasn't changed much. I would suggest, though, it's going to continue to grow as we go forward, given just the attractiveness of our market, our affordability, maybe first and foremost. Our average rent here is about $1,200 on average, with an average income of about $66,000. So our rent to income ratio is very balanced relative to some of the other major markets out west, specifically California. And so, yes, I think that will grow. That's probably a little bit more specific in that, $40 million price point and below. But it's been a big driver in our market, and I only see that expanding as we go forward.
So I recently closed a deal with your Texas IPA office. It was probably our 8th or 9th transaction I've done with them. So we just had a closing dinner, and we're talking about how good of a year we had, and they were saying how you and Steve have really absolutely killed it. I know as we're kind of preparing to record today, you said you guys sold in 2020 about $1.7 billion in sales, and I think you guys led the nation for IPA with your team in Phoenix. So seems like your market's absolutely on fire. I don't know if you can maybe kind of just talk about the general state of the multifamily sales market right now out there, and if you have any sort of examples of a recent transaction that you guys marketed and sold that maybe kind of encapsulates what's going on, that'd be great to kind of share that.
Yeah, absolutely. Well, I will say this, we're very privileged to be in a market like Phoenix. It's very liquid, high velocity. Historical average hold horizon has been just under 4 years. And I also think that will change as we go forward, but that has been the history. And so we've had the privilege of selling the same asset, in some cases 4 times in this cycle. So I think a lot of our success, one, is attributed to the clients that entrust us with their business first and foremost, but being in a very transaction-heavy market like Phoenix, in a market that has only about 1,200 buildings in the 100-plus units space. So as great as our market and economy is, it's a relatively small market compared to a Texas or some other markets that are very in high demand right now. So it's, I think part of that is just being in Phoenix at this point in time. But to give you a flavor to your question about a recent deal story, we awarded a deal at the end of last year, and it's mid-'80s construction, just to give everybody here watching your show a sense. Mid-'80s built. It's a deal that was very much value add. Ownership did most of the common area, nearly all of it, but really set the stage for the value add execution, permitting for washers and dryers, renovating a few units to prove the concept. And so created this color by numbers roadmap that was received well in the market. So the unit count was about 225 units, and the transaction will close just over $40 million. So right really in the sweet spot in terms of unit count from an efficiency perspective or a scale perspective, and then dollar volume, where we were attracting some institutional equity all the way down to the private syndicator investor. So property tour count on that deal was 33, and number of offers was well in excess of 20. And everybody was so tightly bunched, we had to invite 12 groups to the best and final.
Oh, wow.
Which I know is obnoxious, and especially to the investment community, but sometimes you don't have a choice. And that 12 turned into 6 buyer interview calls, which can be very cumbersome for everybody involved. And that 6 turned into 3, and it was really, a 2 or 3 best and final scenario. So that's pretty typical for a down the fairway value add deal today. I know it can be very painful and frustrating for the investment community, but that is simply some evidence of just how our market is. It's not by choice that we have to run a process like that. It's just simply supply and demand driven.
And have you sold that property before, Cliff, prior to this transaction?
Have not. No, had not traded that one. It'll close here pretty soon. So this will be my team's first go around with that asset.
So you're talking, if I could, I hate doing math on the fly because I get a little performance anxiety doing math, but that's about 175, 180,000 a unit, somewhere in that general vicinity, if I did my math right. Do you have any sort of sense what that would have traded for 4 or 5 years ago per door?
Well, to my point about the average hold horizon, ownership has only owned the community about 2 years. So and it had not previously traded for 10 plus years prior to that, almost 15 years. So a few years back when they purchased it, it was closer to about 120 a unit.
Okay.
So, some of that is cap rate compression, clearly, but a lot of that is the tremendous work that sellers are doing out here. This seller in particular, and other sellers, where they're going in and strategically investing their dollars in the right place, generating great rent premiums for that work. And like I said, really handing over the roadmap to the buyer, and they can really back into, the yield hurdles that Phoenix is trading at now.
Have you guys sold any brand new development Class A properties from the developer recently? And how does that transaction go relative to the value add? Do you still have similar demand?
Similar demand. It's not quite as robust because most of the capital still wants value add, especially in a high growth market like Phoenix. But yes, we do a significant amount of the core product, developer, seller, sales in town. And, I'd say the demand is very strong, not quite as where the value add is today. But really, those year one cap rates are going to be pretty comparable. I would say that's probably the takeaway. Generally, Phoenix is trading between a 4 and a 4.5 today.
Okay.
On a cap rate basis, irrespective of class, quality, location.
What's like a generic suburban wrap product trading for now, straight from the developer? Or what's the approximate range per door?
In a good location, you're going to be in the low 300s per unit. And I cite that because we closed the deal in mid-November last year. Very well located suburban product, very well known, high quality developer. And that was just over 300 a unit.
So there's still, while the cap rates are about the same year one, there's still about 100,000 or so spread per door from your workforce housing up to brand new development.
Yeah, if that. In that example, it was a 435 year one, and a value add deal. The one I mentioned previous was almost a 4, high 3s, but year one is, depending on buyer's final underwriting and final budget, 4.5, 4.6. They're going to move that cap rate maybe 50 basis points in the first year.
Okay.
Obviously, the goal is to move it more in the out years, but really, when you're looking at the in place or year one, it's going to be very, very comparable. Your capital sources and your buyer profiles are different, but the yields aren't that different.
If I want to come into town and look for what's the best opportunity right now, in your opinion, if you're coaching me coming in from Texas trying to go to Phoenix, what would be the best part of the marketplace right now? Institutional, brand new Class A, the value adding, any sub-markets you think are a little bit more on the up and coming versus some others?
Yeah, I would say to the first part of the question, it depends, of course, what the capital needs are. What you're trying to accomplish, trying to get a little bit more levered yield, safety, preservation. So I'd probably ask a few more of those questions before I hone in. But I think the location conversation is one that we're having very often with first-time groups, because Phoenix, as a general statement, is doing extremely well. Our fundamentals are strong. Supply and demand imbalance, if we look out 10 years, exceptionally strong. But I think from a sub-market perspective, we're really bullish on the West Valley right now, just as an example, because there have been two major infrastructure projects complete in the last 5 to 7 years. The Loop 303, and then most recently, about a year ago, the Loop 202 extension went in. And that was the largest infrastructure project in the state. It was $1.7 billion, and it created 22 miles of new freeway.
Oh, wow.
So obviously that's going to create a new economic corridor, but that particular stretch of freeway goes behind what's known as South Mountain. And so it connects I-10 in the West Valley with I-10 in the Southeast Valley. So from a logistic perspective, it allows the movement of goods through the valley to really be a lot more efficient and really cut that time in half. That's why you see Amazon, Sub-Zero, Wolf, Boeing, a lot of these big manufacturing facilities are being built in the West Valley for those logistic reasons. And then travel time. You could now easily work in the Southeast Valley, but live out west for that lower cost alternative, because again, your time is cut in half. I mean, truly. So it's been a game changer.
Is there a lot of existing workforce housing stock out there, and are the developers now putting new supply to follow the highways?
It's growing, yes. There's definitely a full pipeline, but not to the point where there's any short-term concern. You know, the single family for rent concept is very prevalent out there right now, just given where the land affordability has been and, the density and site requirements, but still very balanced. What we're seeing is the 80s stock, the C and B stock out there is just absolutely on fire. We're bringing out a deal this week as an example, 84 construction with a really attractive value add component, and just preparing to get into the market this week, looking at some of the stats. RealPage, for example, quotes the Far West Valley as 7.6% rent growth in 2021.
Oh, wow.
So it's pretty incredible. And then if you were to follow that Loop 101 or 303 north, and you get kind of through the Arrowhead pocket, extremely desirable, low supply market, and then you move into the North Valley, similar dynamics as the West Valley, where there's great freeway infrastructure. And that's another market that I would really pay a lot of attention to. And that's where the Taiwanese semiconductor manufacturing company just announced in December that they're going to build their facility. They bought just over 1,100 acres from the state of Arizona. And the plan is to build a $12 billion facility and create about 1,900 jobs in the next 7 to 8 years.
Yeah, so it seems like the market, probably all across the board, is doing really well. Probably many pockets with a lot of job growth, and the multifamily renters kind of following the job. If you're looking at various groups, like you mentioned earlier, you had 33 offers and 12 in the best and final. Are you seeing that the Syndicator, the private capital guys, are being extremely competitive today with the institutional buyers, and are they able to almost win more of these opportunities than say they would have 4 or 5 years ago? Is that kind of the case? Because I'm noticing that here in Texas, where if I'm more on the private capital side, so if we're going up against an institution, we're honestly having a little bit of a much easier time today compared to them a few years ago, because we're able to do things like go hard with earnest money out of the gate and be a little bit more aggressive on some of the terms, where these institutions historically just can't, just kind of by their investment mandate, go hard with money and waive certain contingencies. Is that also the phenomenon going out in Phoenix?
Yes, very much so. I would say we're seeing that non-refundable money really on every single deal, whether it's brand new or built prior to the 1970s, which is essentially the oldest our stock gets. So it's very difficult to beat out a private group that has that ability. Some cases has the ability to not do due diligence, or a very, very short due diligence. sign the PSA within a day or two with very minimal changes. So yeah, I would say it's probabilities driven. Obviously, the institutions are capable and more than qualified, but when there's several options at the table, generally a seller is looking at probabilities and what's kind of the way to maybe de-risk the transaction as much as they possibly can.
So maybe talk a little bit about kind of what's going on right now. I know you have a handful of listings coming out. Maybe talk about two of them. I don't know if you have a kind of a workforce housing example and maybe more of a brand new construction deal. What is the flavor if I'm going to Phoenix looking right now? What does that look like coming up on the market?
Sure. Yeah, I'll talk to that deal that I generally mentioned a minute ago. So the deal we're going to bring out this week is 84 built. It's about 150 units. B minus product, maybe C plus, depending on your criteria. But full size washer dryer, side by side, always a very attractive attribute in the 80s space. And that's a deal that we'll be out with midweek probably. And it's probably 4.25, 4.3 cap rate. Given the dollar volume, that one will be generally in the $30 million range. You'll see almost exclusively private capital. But we have been somewhat surprised that even though the dollar volume isn't what you think it would need to be for institutional money, for the right opportunity, we could see a little institutional interest there. And then on the other end, the spectrum, more A minus deal, an asset we brought out last week. That's much bigger. It's 97 built, just under 500 units. And that deal has 77% of the interiors left to renovate to a platinum level finish. Institutional seller, so the asset's well cared for. Capital's been invested in all the right locations on the common area, but really the opportunity to finish the interior value add execution is there. And in that example, the in-place rents are just under $1,240, and we are projecting a $150 to $175 monthly rent premium.
Okay.
Once the platinum finishes are put in place, and that one's probably a 4.15 cap. So if you call that A minus, and then my B minus C plus example, in a sense, maybe there's 20 basis points more in going in cap rate, but that's about it.
What does that look like on a per door basis for the 80s roughly and the 97 product?
Yeah, roughly I'd say 185 for the 80s built and 250 for the late 90s built.
And I think really from my perspective, comparing Arizona to Texas, the cap rate sounds pretty similar, but the price per door basis you're quoting is probably 35% more per unit in Phoenix than what we see in Dallas, even though the cap rates are the same. So it seems like really the main difference from my perspective is really the taxes and the insurance in Arizona are materially lower than what they tend to be in the Texas markets that I play in. Maybe talk through that a little bit, because I know that's a little bit unique to your market relative to Texas and a lot of the other places across the country.
Yeah, no, I think you nailed it, Michael. Taxes, probably the biggest headliner. Back in 2015, we passed Proposition 117 in Maricopa County. And what that really did was limit our limited property value growth by 5% per year. So now by law, the limited property values cannot grow by more than 5% annually. And limited property values are the only values the assessor uses to calculate real estate taxes. And a sale has nothing to do with a reassessment. And it's a disclosure state, so every sale is public. But a sale does not trigger a reassessment, and our buildings are assessed on a 2-year roll. So you know what the 21 and 22 assessments already look like. The only variable is where tax rates will come in the beginning of September every year. And so you're going to have a primary and a secondary tax rate annually. So we won't know 2021 rates until September, but we already know 21 and 22 assessments. And 23 cannot grow by more than 5% at 22. So it's extremely predictable.
Yep.
And easy to underwrite real estate taxes.
Is there much variance within the rates, or the rates generally pretty stable as well?
Rates are generally pretty stable.
Yeah.
Like I can tell you what, as an example, just case in point, what we'll typically do is just max out the LPV by 5%. And then at this point in the year, since we don't know 2021 rates, we'll keep rates consistent with 2020. But since we caught the 5% growth in the LPV, that essentially is going to get us very close to where the actual 2021 taxes will be.
If I'm coming in from out of town, what are one of the two things I could do to prepare myself to be a little bit more successful entering in the Phoenix market if I want to come from Texas or California to your market? What are one or two things that I should really do to catch your attention and increase my chances of winning a bid that we're chasing after?
Yeah, great question. What I have said historically and continue to say is just create mind share with my team and me. You could imagine we're getting a tremendous amount of calls. And so to the degree you and your team come into town, we meet in person, we're in touch as often as humanly possible. A buyer that's behaving that way is not going to frustrate me, but rather communicate their sincere interest in being in the market. So I think as we spend time touring, we're talking on the phone consistently, you're executing our CAs, that relationship building, I think is critical, because along the way, not only are we getting to know one another, but you're following the deal flow and you're getting real-time feedback, like what the terms need to be, where the pricing guidance is, ultimately where did that deal trade relative to guidance. So I think not only does it educate me as the intermediary, but you as the buyer, as you do that consistently for a quarter or two. And then I think beyond that, just demonstrating that you've got your team in place. If you guys manage in-house, here are our boots on the ground. Here's how they're deployed. If we use third party, here's who we work with. And you're doing that sub-market homework in advance of bids. And so when you come to the table with your letter of intent and supporting documentation, buyer questionnaire, your I's are dotted and T's are crossed.
Yeah, no, that's some great advice. Cliff, I appreciate you coming on today. If there's anyone wants to find out more information about you guys, want to get on your distribution list, what's the best resource to learn a little bit more about you guys and what you guys are out there selling?
Yeah, so I think a business email rather is cdavid@ipausa.com. And direct office line for me is 602-687-6763. And then we do have a team's website as well, which is David-Gebbing. So DAVID-Gebbing, GEBING.com.
Cliff, appreciate your time. If anyone's out there interested in getting into Phoenix, Cliff and Steve sell as much as anybody out in the marketplace. Highly encourage you guys to reach out and get on their list, start following it. Phoenix seems like a unbelievable market, and I know I went out there a few years ago and ultimately ended up not participating buying, and that clearly was a mistake. Should have participated back in 2016, but it is what it is. So I think that the growth of the market still looks like they have quite a bit of legs with it, with all the relocation, the economic immigration coming primarily from California to places like Arizona, Florida, and Texas. Seems like it's got many years of runway ahead of it. So I'm sure Phoenix is going to be a phenomenal market for many years to come. So Cliff, appreciate your time today. For Cliff, I'm Michael Becker. See you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.